Let's be honest, the markets have been a wild ride lately, and the headlines? They're just full of noise. But what if the real reason for this big sell-off isn't what everyone's talking about? Well, in today's brief, we're going to cut through that noise and follow the money to find the real story. It's the question that's probably been bugging every single one of us. You see the headlines blaming everything from inflation to geopolitics, but those explanations just feel like they're missing something, right? So what's really going on?
And here's the thing, the answer isn't some flaw in a particular stock or a crypto asset. The real story is hidden deeper, down in the plumbing of the financial system itself. It's all about the flow of money, and right now, a huge amount of it is being quietly siphoned right off the table.
All right, so first things first, let's look at the symptoms. Before we get to the cause, it's so important to see just how extreme the fear in the market has become. We're talking panic.
And wow, the data paints a crystal clear picture of just outright panic. For instance, the Coinbase Premium Index is showing historically negative readings, which tells us there's some really heavy selling pressure coming from the US. We're also seeing record-breaking outflows from major Bitcoin ETFs. And get this, even a company like MicroStrategy is trading for less than the value of the Bitcoin it holds on its books. These are all classic signs of capitulation. That's that moment when investors just throw in the towel and sell, no matter what the price is.
Okay, so what in the world is causing all this panic? Well, the prime suspect, it's not what you think. It looks like a massive and very deliberate withdrawal of liquidity from the entire financial system.
So when we talk about liquidity, what are we really saying? You can think of it like the amount of water in a pool. It's the cash that's just sloshing around the system ready to buy up assets. When that pool of cash starts to shrink, well, there are fewer buyers and it becomes a whole lot easier for prices to drop.
And this chart, this shows us exactly where that money disappeared to. The US Treasury's cash account at the Federal Reserve nearly doubled in just a couple of months. Now think about that for a second. Every single dollar that goes into this account is a dollar that's been pulled out of the banking system and away from the markets. This is the liquidity drain, happening in real time.
But here's the kicker. This kind of drain doesn't hit the market instantly. There's a lag. Our analysis shows it takes roughly 60 days for this kind of liquidity change to really work its way through the system and hit asset prices.
So let's just trace this out step by step. The Treasury started pulling all that cash out of the system back in August and September. Now, you fast forward about 60 days, and where does that land us? Directly in mid-November. It is absolutely no coincidence that this is exactly when the most intense selling pressure smashed into the markets. It was basically right on schedule.
Now, if you don't feel like tracking the Treasury's balance sheet every single day, and who does, right, there's an easier way to keep an eye on this. A strengthening US dollar index is often a direct reflection of tightening global liquidity. It's simple. As dollars become more scarce, their value goes up.
So what does this liquidity crunch actually feel like on the ground, in the markets? Well, it puts immense pressure on the key players, and you can literally see the stress in the data.
Think about the market makers for a second. These are the big firms whose job is to provide constant buy and sell orders to keep things stable. But after getting hit by all this volatility, they've become, well, groggy and cautious. They're offering up fewer buy orders, which means there's a much thinner safety net to catch prices when a big wave of selling hits.
And this quote right here, it adds another really interesting layer to the puzzle. This isn't just some generalized global panic. Specific data is pointing to the selling pressure originating heavily from US-based investors, which lines up perfectly with the liquidity drain being driven by the US Treasury.
Okay, so let's recap. We've identified our cause, this massive liquidity drain, and we've seen the effect, peak fear. So the next logical question in our investigation has to be, where does this thing stop? Where might the market finally find its footing?
When you pull up the charts, it's really like a tale of two different stories. On one hand, yes, the sharp, short-term upward momentum is completely broken, and that's what triggered this waterfall decline. But, and this is the crucial part, the broader long-term market structure is, so far, actually holding.
This visual really helps us zoom out and see the bigger picture. The price has fallen to a really critical rising trend line that connects the major lows from back in September 2023 and August 2024. So yeah, while the recent drop feels absolutely brutal, the market has landed on a level that has historically served as a major floor.
And if that's not enough, we can add another piece of evidence to the pile.
Momentum indicators like the weekly RSI are now deep in oversold territory. We actually haven't seen readings this low since the major market bottoms back in 2022, which suggests that this selling pressure might just be getting exhausted.
So we've laid it all out. The cause, the evidence, a potential support zone. What does this all mean for us? Trying to make sense of these crazy markets and navigate what comes next.
Okay, so based on everything we've talked about, here's a pretty straightforward framework you can use. Step 1. Keep an eye on the Treasury's cash balance. When you see it start to consistently go down, that's your signal that liquidity is flowing back into the system. Step 2. Just add our 60-day lag to that signal. And step 3. This whole thing points to a true, sustainable market bottom potentially starting to form around December, or maybe even a bit later.
And this all leads to a really crucial, almost timeless investing principle. The crowd is almost always wrong at major market turning points. As one veteran analyst put it, his biggest gains always came when he went against the dominant narrative, not with it. That means the greatest opportunities often show up when fear is at its absolute peak.
And that really leaves us with one final powerful thought to chew on. We've pretty clearly established that we are at or very near a point of maximum pessimism. History tells us again and again that these are precisely the moments that come right before major turnarounds. So the key question for you to consider is, does all this widespread fear represent a warning to stay away? Or is it a signal of a generational opportunity?